The rise in yields he just mentioned, touching off a sell-off in stocks again today. But if we've shrugged off rising yields in the first half of the year, why aren't we shrugging it off anymore? Let's turn to our panel to make sense of it all. We bring in Julia Coronado. She is president at Macro Policy Perspectives. Wells Fargo Advisors Mark Smith is here with me on set. Welcome to you. Steve Leisman, Rick Santelli, everybody is still in the mix. Julia, first to you. And I heard you listening and pondering, and I wanted to know what you were thinking about all of this today.
Yeah, so I think Rick makes a great point, which is that, the ISM employment index seems to be at odds with the slowing in hiring that we're seeing pretty decisively now in the employment report. And I think we got to keep in mind it's a diffusion index. It captures the share of industries that are still hiring versus firing, but it doesn't capture the intensity of that hiring. And when we look at earnings reports, what we see is that companies are reporting slowing down hiring, being more patient, being more picky. So they're not actually that inconsistent with each other. Industries are hoarding labor. They don't want to let go of people after having had such a hard time staffing back up, but they are slowing their hiring. Look at revenue growth expectations for the S&P 500 this year, 2% nominal.
Right.
That's not great growth against which to hire a lot of new workers. So I think that the hard activity data is telling us the economy is slowing. Company reports are telling us that, but some of these signals are at odds with each other, and there's a lot of uncertainty. So the Fed keeps pounding home higher for longer on rates, and the market's taking them at their word.
Steve, real quickly before I bring Mark in, did the Fed funds futures move? So if this whole thing is about how maybe we haven't, totally ruled out more hikes, did we see a budge in those expectations? Let's maybe say maybe not so much for September, but for November.
Yeah, they were trading in the low 40s for November, but now they're trading sort of towards the 50% line. 56, I think,
Wow.
percent probability of a hike in November has been the upper end. But I want to take the other side of the trade on the soft employment report. When I looked into the details of it, I counted 36,000 truckers that had lost their jobs from the Yellow bankruptcy. There were some 18,000 people on strike. And then another weird thing, which is 15,000 teachers not employed or lower than it had been. So I'm not sure the employment report was quite as weak as everybody said. Yes, it was softer, but I don't know that I'd call it soft. And I don't find this service sector number employment index at odds with what's going on in the job market.
All right, interesting. Mark, I want to turn to you to kind of put this where the rubber meets the road. What do you make of the sell-off in equities the past couple of days? Do you think it's in response to higher yields and this kind of anxiety about, inflation and the Fed?
At the end of the day, when I'm talking to my clients, they're up 15, 16% since January. So although this is like, a lot to talk about today, when you're looking at your portfolio, and I'm talking about giving performance reviews, we're up double digits. So no one's really too concerned right now. What we should be concerned about is the fact that the Fed may want to go higher for longer, and that may mean, a rate increase, and then that may stay there for a while. And I think there's a lot of data that's pointing in that direction. You see that the price of crude is up 10% this month.
Right.
You're seeing that Russia and OPEC are going to combine to try to lower how much output they're going to put out. So all these things I think are going to be more inflationary.